The International Monetary Fund, IMF, has cut its global growth forecast for 2023 as economic pressures collide, from the war in Ukraine, high energy and food prices, and sharply higher interest rates. The IMF warned on Tuesday that conditions could worsen significantly next year and said it expected more than a third of the world's economy to contract. The 19-country eurozone, which will grow to 20 members from January 1, 2023 with the adoption of the single currency by Croatia, is now projected to post the slowest growth of any region worldwide next year after the IMF cut its forecast by 0.7 percentage points from its previous outlook delivered just 3 months ago. Germany, the European Union's economic powerhouse, is now expected to post negative annual growth, minus 0.3%, as is Italy, minus 0.2%. The outlook for France and Spain remains positive, although lower than the July forecast, with annual GDP now seen at 0.7% and 1.2% respectively. The Washington-based financial institution kept its projection unchanged for the U.S., which is seen growing by 1%, while Asia is expected to post the highest growth of 4.9%. Welcome to Savvy Economists. Today we awake to a forecast by the International Monetary Fund of global growth set to be cut from its previous forecast. This means that even darker clouds hover above the world economy as we go into a new year. As we go into the video, don't forget to hit the like button, subscribe, and turn on notifications. In its World Economic Outlook, the IMF said global GDP growth next year will slow to 2.7% compared to a 2.9% forecast in July, as higher interest rates slow the United States economy, Europe struggles with spiking gas prices, and China contends with continued COVID-19 lockdowns and a weakening property sector. The fund is keeping its 2022 growth forecast at 3.2%, reflecting stronger than expected output in Europe but weaker performance in the U.S. after torrid 6% global growth in 2021. U.S. growth this year is forecast to be a meager 1.6%, a 0.7 percentage point downgrade from July. The drop reflects an unexpected second quarter GDP contraction. The IMF kept its 2023 U.S. growth forecast unchanged at 1%. Eurozone growth will fall to 0.5% next year as high energy prices slam output, the IMF predicted, with some key economies, including Germany and Italy, entering technical recessions. Gurrinches said geopolitical shifts in the continent's energy supplies will be broad and permanent, keeping prices high for a long time. Regarding market turmoil in Britain after financial markets rebuked the new government's proposed tax cuts, Gurrinches said UK fiscal policy needed to be in step with central bank inflation goals. Last month, inflation in the euro area reached 10% for the first time, fueled by energy prices that have soared over the previous 12 months as a result of Russia's full-scale assault on Ukraine. The European Central Bank is attempting to rein in runaway price increases through interest rate hikes. It has already operated its sharpest rise ever and has signaled that further hikes could be mandated over the coming months. The most significant risk for the euro area economy is that we see a further escalation of the forces that are driving the downgrade in the forecast, the IMF's Deputy Director Petia Kuiva-Brooks said in an interview with Euronews correspondent Sasha Vakulina. Namely, the worsening of the energy crisis and having inflation even longer lasting, which will prompt a further tightening of policies and eventually make the outlook in 2023 even worse, she added. The global economy's future health rests critically on the successful calibration of monetary policy, the course of the war in Ukraine, and the possibility of further pandemic-related supply-side disruptions, the IMF said. The economic future, it said, is subject to a delicate balancing act by central banks to fight inflation without over-tightening, which could push the global economy into an unnecessarily severe recession and cause disruptions to financial markets and pain for developing countries. But it pointed squarely at controlling inflation as the bigger priority. The hard-won credibility of central banks could be undermined if they misjudge yet again the stubborn persistence of inflation, Gurrinches said. This would prove much more detrimental to future macroeconomic stability. So far, however, price pressures are proving quite stubborn and a major source of concern for policymakers, the IMF said, adding that it expects global inflation to peak in late 2022 at 9.5%. It is forecast to remain elevated for longer than previously expected, decreasing to 4.1% by 2024. A plausible combination of shocks, including a 30% spike in oil prices from current levels, could darken the outlook considerably, the IMF said, pushing global growth down to 1% next year, a level associated with widely falling real incomes. Other components of this downside scenario include a steep drop-off in Chinese property sector investment, a sharp tightening of financial conditions brought on by emerging market currency depreciations, and labor markets remaining overheated. The IMF put a 25% probability of global growth falling below 2% next year, a phenomenon that has occurred only 5 times since 1970. It said there is a more than a 10% chance of a global GDP contraction. These shocks could keep inflation elevated for longer, which in turn could keep upward pressure on the US dollar, now at its strongest since the early 2000s. The IMF said the dollar's strength is pressuring emerging markets and could increase the likelihood of debt distress for some countries. But Gourinchas said the dollar's strength is currently the result of fundamental economic forces, including the more aggressive monetary tightening in the US, rather than unruly markets. The World Economic Outlook was released as the IMF and World Bank began their first in-person annual meeting in 3 years. Emerging market debt relief is expected to be a major topic of discussion among the world's global financial policymakers at the meetings in Washington, D.C., and Gourinchas said now was the time for emerging markets to batten down the hatches to prepare for more difficult conditions. The appropriate policy for most emerging economies is to prioritize monetary policy for price stability, letting currencies adjust and conserving valuable foreign exchange reserves for when financial conditions worsen, Gourinchas advised. After Mr. Courting unveiled plans for huge tax cuts in the UK, the IMF criticized the plans, warning they were likely to increase inequality and add to pressures pushing up prices. It was an unusually outspoken statement from the IMF, which has a key role in acting as an early economic warning system. The IMF said it understood the government's mini-budget aimed to boost growth, but it said that the tax cuts could speed up the pace of price rises, which the UK's central bank, the Bank of England, is trying to bring down. Downing Street defended the Chancellor's plans, with the Prime Minister's official spokesperson saying its policies aimed to support British people at a time of global high prices, and said the IMF report showed the global challenges that countries are facing. The IMF warned the global economy was facing a downturn, with the worst yet to come as the war in Ukraine helps push prices higher around the globe. It said governments and central banks globally had to work together to help people through the turmoil. The IMF's Pierre-Olivier Gourinchas told the BBC, "Imagine a car with 2 drivers at the front and each of them has a steering wheel and one wants to go left and the other wants to go right." He added, "One is the central bank trying to cool off the economy so that price pressures will ease, and the other one wants to spend more to support families. It's probably not going to work very well." A reduction in the amount of spending by the government related to the pandemic was also one of the big causes of the slump in manufacturing, which was hit by pharmaceutical companies cutting back production. The ONS added that some falls were offset, however, by some professional services like accounting and architecture. The construction sector was the only one of the 3 main parts of the economy to see a growth of 0.4% in August. Some experts expect that September could see an even bigger drop in economic output, with the extra bank holiday for the Queen's funeral and the period of mourning affecting business opening hours, as well as higher costs starting to bite. Yael Selvin, chief economist at KPMG, said that the UK was now teetering on the edge of recession. The ongoing squeeze on household finances continues to weigh on growth and is likely to have caused the UK economy to enter a technical recession. August's drop in GDP likely marks the start of a downward trend that will continue deep into next year, said Samuel Toombs, chief UK economist at Pantheon Macroeconomics. In the UK, the Chancellor has already said he will bring forward his economic plan, where he will spell out how he plans to pay for the tax cuts and provide an independent forecast of the UK economy's prospects, a move welcomed by the IMF. However, on Tuesday, government borrowing costs remained close to the levels seen at the height of the market turmoil last month, despite fresh action from the Bank of England to try and stabilize financial markets. The IMF criticized the UK's mini-budget in stark terms last month, and also repeated a more general warning about untargeted fiscal support, without mentioning the UK specifically. Speaking to BBC's Today program, Business Secretary Jacob Rees-Mogg also urged caution in interpreting the most recent ONS monthly figures for August. He pointed out that monthly figures are often more volatile and very often subject to revision. But he acknowledged that the fall in the economic growth number for August showed the need for the mini-budget in September to make sure we get back onto a path for growth. It comes after the International Monetary Fund, IMF, warned that the worst was still to come for the global economy, while 2023 would feel like a recession for many people because of rising costs and the continued fallout of Russia's invasion of Ukraine. The IMF also cautioned that governments would need to protect the least well-off from the impact of higher prices. Poorer households often spend relatively more than others on food, heating, and fuel. It pointed out all areas that have seen steep price rises as energy and grain exports have been restricted after the invasion of Ukraine. And countries that are reliant on Russian gas in Europe are being hit particularly badly. Germany's economy, for example, is now predicted to contract next year. Meanwhile, Russia's economy is expected to contract by 2.3% next year, the biggest fall of all the nations included in the projections. Speaking on Monday, IMF boss Kristalina Georgieva noted that growth was also being dragged down in China by continued COVID restrictions, while in the US rising interest rates were starting to bite. At the first in-person meetings between the IMF and the World Bank since the pandemic, she said countries could reduce the pain ahead of us in 2023 by acting together. She added that the IMF will be pushing for major economies to carry on with their efforts to bring down the cost of living, even if they have a negative impact on economic growth. If they don't do enough, she said, we are in trouble. We cannot afford inflation to be a runaway train. Economic forecasts doesn't leave any glimmer of hope, and it seems we are unavoidably going to be hit very hard by next year, especially if countries do not work together just as the IMF advised. We would like to hear from our listeners what they think about the recent forecast by the IMF in the comment section. Don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.